Welcome back to the Crypto Intellect, the channel where we break down the biggest developments in crypto, digital assets, and institutional finance in a way that actually makes sense. Today's headline is one that has the entire XRP community talking, XRP news. Today, did Charles Schwab hint at an XRP supply shock? Now, before we get into the details, I want to ask you something. Had you already heard about the recent Charles Schwab XRP futures launch, Mastercard's RLUSD settlement integration, and the growing conversation around XRP ETF demand before watching this video? Let me know in the comments, because what we are discussing today is not just another news cycle. It is a collection of developments that many investors believe could be pointing toward a major shift in how institutions view XRP. As always, this is not financial advice. This content is for educational and informational purposes only. Make sure you do your own research before making any investment decisions. With that said, what happened this week deserves a closer look because several powerful pieces may be starting to fit together. One of the biggest stories came from Charles Schwab, a name that carries enormous weight throughout the financial world. To understand why this matters, you first need to understand who Schwab serves. This is not a company built around speculative traders chasing quick gains. Schwab oversees trillions of dollars in client assets and works alongside thousands of financial advisors who help Americans manage retirement accounts, long-term portfolios, estate planning strategies, and wealth preservation. These advisors are often the first people investors call before making important financial decisions. They operate in a highly regulated environment and generally move cautiously when it comes to new asset classes. That is why many XRP supporters were surprised when Schwab made XRP futures available through its trading ecosystem. For years, one of the biggest barriers facing XRP was limited access through traditional financial channels. Suddenly, that conversation changed. The question is not whether Schwab endorsed XRP directly. The question is whether giving XRP a place within a major brokerage platform signals that institutional demand is becoming increasingly difficult to ignore. When investors hear the words XRP futures, some immediately assume that means institutions are buying massive amounts of XRP. The reality is more nuanced. Futures contracts allow traders to gain exposure to price movements without necessarily owning the underlying asset. However, what makes this important is not simply the futures product itself, it is the message behind the product. Financial institutions do not spend time, resources, and compliance effort integrating products they believe have no future demand. Every addition to a regulated trading platform goes through extensive review processes. Risk teams, legal teams, and executives all evaluate whether a product deserves a place within the ecosystem. XRP now sits alongside other major digital assets that have already gained significant institutional recognition. That fact alone caught the attention of many market observers. It created a new discussion among investors who believe XRP is gradually moving from the outer edges of the crypto industry toward a position that is increasingly accepted within mainstream financial markets. Think about the conversations that can now happen inside advisor offices across the United States. Previously, if a client asked about XRP exposure, many advisors had limited options. Some may have avoided the discussion entirely because there were few regulated pathways available through traditional financial systems. Now, there is a structured product that exists within a familiar environment that changes the dynamic. Advisors do not need to become crypto experts overnight. They simply need access to regulated tools that allow them to discuss opportunities and risks within frameworks they already understand. This is why some analysts view the Schwab development as more significant than it appears on the surface. It is not about a single trading product. It is about XRP becoming part of conversations happening among professionals who influence billions of dollars in capital allocation decisions every year. Whether that leads to significant adoption remains to be seen, but the door is undeniably more open today than it was before. At the same time, another major development emerged from a completely different corner of the financial system. The world's largest derivatives infrastructure continues expanding its crypto capabilities, and Ripple-related services have increasingly become part of that discussion. While retail investors often focus on prices and charts, institutions focus on infrastructure. They care about settlement, clearing, financing, risk management, and operational efficiency. These are the systems that keep global markets functioning every day. When institutional participants see Ripple-related technology appearing within important market structures, they pay attention. That is because large organizations rarely make decisions based on hype. They make decisions based on whether technology solves real business problems. This distinction matters. Retail enthusiasm can create short-term excitement, but institutional adoption tends to develop over years through testing, compliance reviews, and operational integration. Many XRP supporters argue that the infrastructure story is where the most meaningful progress is occurring right now, even if it does not always generate dramatic headlines. Then came the Mastercard announcement, which added an entirely new layer to the conversation. Mastercard revealed expanded stablecoin settlement capabilities designed to support around-the-clock transactions, including weekends and holidays. For most consumers, payments feel instant already. You tap a card, make a purchase, and move on with your day. Behind the scenes, however, settlement is often more complex than people realize. Traditional systems involve multiple parties, banking schedules, processing windows, and delays that can create inefficiencies, particularly for large organizations handling global transaction volumes. Stablecoins offer a different approach. Because they operate on blockchain networks, transactions can be processed continuously rather than waiting for traditional banking hours. This is one of the reasons stablecoins have become such an important topic within financial circles. They address real operational challenges that businesses encounter every day, and major payment companies are increasingly exploring how to integrate them into existing systems. What truly grabbed attention was the inclusion of RLUSD, Ripple's stablecoin, among the supported settlement assets. For XRP supporters, this was viewed as more than a simple mention in a press release. Mastercard operates one of the largest payment networks in the world. Decisions made by organizations of that size are rarely random. They evaluate technology, compliance requirements, scalability, and long-term viability before integrating new solutions. Seeing RLUSD mentioned alongside other established stablecoins led many investors to believe Ripple's ecosystem is gaining recognition among major financial players. At the same time, the XRP Ledger itself was identified as part of the settlement infrastructure. That combination sparked immediate discussion throughout the crypto community because it connected Ripple's stablecoin ambitions directly with one of the most influential payment networks on the planet. Whether this becomes a transformative partnership remains unknown, but it certainly reinforced the narrative that Ripple's technology continues expanding into important financial conversations. Another piece of the puzzle involves long-standing relationships that many casual investors rarely discuss. Some partnerships take years to mature before they become visible to the public. Infrastructure projects are often developed quietly through testing, regulatory reviews, operational adjustments, and strategic planning. By the time the public hears about them, much of the foundational work has already been completed. This is why many observers paid close attention to the institutions named within Mastercard's broader settlement initiative. Several organizations connected to Ripple have maintained relationships spanning many years. Those relationships may not generate daily headlines, but they often reveal how enterprise adoption actually develops. Real-world financial infrastructure is built slowly. It evolves through trust, performance, and consistency rather than viral social media posts. When companies that have worked together for years begin appearing within larger public initiatives, investors naturally start asking whether deeper integration is taking shape behind the scenes. Now let us move to the topic that may explain why some analysts are beginning to talk about a potential XRP supply shock. The phrase supply shock refers to a situation where available supply becomes increasingly constrained while demand continues growing. Whether XRP is heading towards such a scenario remains highly debated, but recent comments from industry researchers have fueled the conversation. According to projections discussed within the market, XRP exchange-traded funds could eventually absorb a meaningful percentage of circulating supply. If large amounts of XRP become locked within regulated investment products, those tokens are effectively removed from active trading circulation. This does not mean they disappear. It simply means they become less available for immediate buying and selling activity on open markets. Historically, supply reductions combined with increasing demand have been important factors influencing price movements across many asset classes. That is why investors are paying such close attention to ETF growth trends. The ETF story is particularly important because it represents a bridge between traditional finance and digital assets. Many institutional investors cannot simply open a crypto exchange account and start buying tokens directly. Their mandates, regulations, and operational requirements often require exposure through regulated investment products. ETFs provide that pathway. As more financial institutions gain access to XRP-related investment vehicles, analysts are watching whether asset accumulation accelerates. Recent growth in XRP ETF holdings has encouraged supporters who believe this trend could continue expanding. If these products eventually capture several percentage points of circulating supply, it would represent a substantial shift in market structure. Again, nothing is guaranteed. Projections are not outcomes. However, the possibility itself has become one of the most discussed themes among XRP investors because it introduces a completely different demand dynamic compared to previous market cycles. Adding another layer to this discussion is the growing role of decentralized finance ecosystems connected to XRP. Various projects are exploring ways to bring XRP into lending, staking-like mechanisms, liquidity pools, and other blockchain-based financial applications. Whenever assets become locked within these systems, they may contribute to reduced liquid supply available on exchanges. Some analysts have suggested that if ETF accumulation and DeFi participation expand simultaneously, the combined impact could become significant. This is where the supply shock narrative gains momentum. Supporters argue that demand channels are multiplying while portions of supply are gradually moving into long-term holding structures. Critics, however, point out that market conditions, investor behavior, and regulatory developments can change quickly. Both perspectives deserve consideration. The important point is that the conversation has evolved beyond simple price predictions and now focuses increasingly on structural market dynamics. When you step back and connect the dots, you begin to understand why this week generated so much excitement. Charles Schwab expanded regulated access to XRP-related products. Ripple-linked infrastructure continued appearing in major institutional market discussions. Mastercard integrated RLUSD and the XRP Ledger into its settlement framework. ETF accumulation projections suggested the possibility of meaningful supply absorption. These developments came from different sectors solving different problems. They were not part of one coordinated announcement, yet many investors see a common thread running through all of them. They believe XRP and Ripple-related technologies are increasingly appearing wherever financial institutions are searching for more efficient ways to move value, manage liquidity, and access digital asset markets. Whether that interpretation proves correct over time remains one of the biggest questions facing the industry. This brings us back to the headline of today's video. Did Charles Schwab hint at an XRP supply shock? Strictly speaking, Schwab did not publicly declare that XRP is heading toward a supply crisis. What happened was something more subtle. By providing regulated XRP futures access within a major brokerage environment, Schwab added another potential pathway through which institutional interest can develop. When viewed alongside ETF growth, stablecoin expansion, and broader Ripple ecosystem adoption, some analysts believe these developments collectively point toward tightening supply conditions in the future. The key word there is future. Markets move based on actual participation, not assumptions. Still, investors often pay close attention to early signals because they can reveal changing trends before those trends become obvious to everyone else. For years, many XRP holders maintained a simple thesis. They believed the real story was not short-term price action, but long-term institutional adoption. Through bull markets, bear markets, lawsuits, regulatory uncertainty, and endless debates, that thesis remained largely unchanged. The question was whether major financial institutions would eventually embrace infrastructure connected to XRP and Ripple technology. Recent announcements have not fully answered that question, but they have certainly added new evidence to the discussion. Instead of relying purely on speculation, investors now have concrete developments to analyze. That shift alone is significant because it moves the conversation away from theory and toward observable market activity. Whether you are bullish, bearish, or somewhere in between, it is becoming increasingly difficult to ignore the growing number of institutional names appearing around XRP-related narratives. One final factor worth watching is regulation. Many institutions remain cautious because regulatory clarity continues evolving across digital asset markets. Several major players have already begun building infrastructure despite existing uncertainty, which some analysts view as a positive sign. Others believe broader participation may accelerate if clearer legal frameworks eventually emerge. Either way, regulation remains one of the most important variables influencing future adoption. If additional clarity arrives, investors will be watching closely to see whether institutions that have been observing from the sidelines decide to become active participants. That possibility is one reason why many market observers believe the next chapter for XRP could look very different from previous years. As we wrap up today's discussion, one thing is clear. The conversation surrounding XRP is no longer limited to crypto enthusiasts on social media. It now involves major brokerages, global payment networks, institutional research teams, and expanding investment products. Whether these developments ultimately lead to a true supply shock remains uncertain, but the conditions that supporters have discussed for years are beginning to appear in tangible ways. The infrastructure story is becoming harder to dismiss, the institutional story is becoming more visible, and the supply conversation is gaining momentum with every new development. So now I want to hear from you. Of everything we covered today, what stands out the most? The Charles Schwab XRP futures launch, Mastercard's RLUSD integration, or the possibility of ETFs absorbing a significant share of XRP supply? Drop your thoughts in the comments below. If you enjoyed this breakdown, make sure to like the video, subscribe to the Crypto Intellect, and share this with someone who needs to see the bigger picture. Stay informed, stay prepared, and I will see you in the next one.